Interested in real estate? How about wealth? Well, they go hand in hand. And here, you'll learn all about it. Welcome to Be the Bank, a podcast where we discuss and debate the topics centered around real estate investing. Your host, Justin Bogard, shares insights into investing in real estate to create real wealth and passive income for you and your family. He'll share stories of real estate investments done right, walk you through the process of owning a real estate note, and most importantly, educate you so you can be the bank. This is Be the Bank, brought to you by BrightPath Notes. Now, here's your host, Justin Bogard.
Welcome to episode number 8 of the Be the Bank podcast, season number 4. And I'm going to have my friend Richard Thornton on here in a minute. And we're going to talk about interest rates and what they're doing right now. And what does that mean? And what does that really affect when it comes to real estate? And obviously it has other economical impact things. So stay tuned and you will hear all about it. This episode is brought to you by BrightPath Notes. Richard, good morning, good afternoon to you. How are you?
Good morning. I'm good, thank you. I think we've probably switched situations weather-wise. It is cold, gloomy, and rainy here in Northern California.
Oh.
We need the rain, so that's a good thing.
Well, okay.
I imagine you're having much better weather than we are.
You know, the sun is out today, but it's very, very windy today. So I'm recording here in the camper today, and so I felt it kind of rock a little bit. Well, doing a little pre-game session. So I was like, okay, well, I'm hooked up to battery power. So if things go out, at least I can still, stay live on the recording here. So
right.
All right. Thanks for hopping on today. Like I said, this is episode number 8, brought to you by BrightPath Notes. And so you've been on before, so we don't really need to go through your bio and stuff. You've been on a couple times, but for the interest of my listening audience here, so you kind of have a specialty from your past, which is kind of in, I'll just call it commercial lending as general. If you want to specify it, you can. But what I think is very interesting right now is how the interest rates have kind of creeped up right now. And as of the bank rate data that I looked at today, as of recording this on April 14th, it says there's a 5.06% interest rate as a national average for consumers on 30-year loans.
Right. So 60 days ago, you could get 30-year fixed at a full percentage point less than you can right now, which means the Fed is moving pretty quickly. All these supply chain problems we're having are causing them some angst, and they want to cool things down a little bit.
Yeah, I feel like since the past, 5-6 years, it's just been feeling like, okay, the interest rate's anywhere from 2 to 3%. That's pretty low. And whether I get it at 2, whether I get 3%, I'm happy either way. And now that it's jumped up close to 5, I'm thinking, oh, wow, that feels a lot more aggressive than what I was used to seeing like every day. And people talk about interest rates. So for me, Richard, it's crept up quite a bit to where I wasn't paying attention to it because I'm not getting personal loans right now. And so to me, it was very interesting. So I don't know what your take on it, if you had been monitoring it that closely when it hit over 5.
Well, we have to look at it historically. When I'm dating myself here, but when I originally started lending back in the 80s, Paul Volcker was just finishing up his tirade on raising rates and things like that. And as you heard me say before, short-term rates were as high as 21%. And there was his program brought inflation to a screeching halt. The biggest thing, though, back in those days was that we were in a smaller fishbowl. We didn't have the globalization that we have today. So we were more insulated from international rates.
Okay.
So it was easier, just as it doesn't take much water to increase the level of a fishbowl. But if you've got a huge lake or an ocean, to get a little bit of rise out of that, it takes a lot more water. And so globalization has had a real moderating effect on interest rates worldwide. So when the Fed does something like this, it really is surprising because you don't expect them in these days of globalization to move rates as quickly as they have.
Yeah, and I know you and I had talked about this before, about the Fed, how many times they were going to raise the rates this year, and as of we're recording this on April 14th, it looks like they're going to raise it at least 5 to 6 more times in
That's what they're
2022.
projecting. Yeah, we'll see if that comes.
Yeah.
It depends on supply chain issues, but the outlook is not very good right now. I mean, I don't know if you've been reading about China's reoccurrence and re-lockdowns. But we're going to have major supply chain problems here for the next year, I think.
Yeah. So the interest rate raising, obviously, thanks for bringing up the international aspects of it, because they are very important, because they're going to affect us, here again soon. The real estate market, I can see this real estate market cooling down as far as being a hot seller's market and cooling it back down to maybe getting closer to about what a buyer and seller's market should be on average, on even playing field. So the affordability aspect of a homeowner. So Black Knight Financial Data, I know you look at this data too, Richard. They tell us what a median price home is across the country. And what that number, let's just call it $275,000. And they take the median price, the median income that someone has, and then they figure out what can they afford to pay monthly. And so that number right now is $1,700 a month for a 30-year fixed mortgage with a 20% down payment. And that's what they're saying right now. So as the interest rates are creeping up, that's making that number jump higher. So it would seem to me that this rate increase and more rate increases, depending on how high it goes, is going to put people out of being bankable for their home, on a new home.
Yeah, I would think so. I mean, that's the natural progression. As rates go up, fewer people can afford the payments. The offset on that is, I mean, let's face it, the lower interest rates have been part of the reason that the housing market's been going as crazy as it has. But two of the other big drivers, and a big part of it is tech. I mean, you got a lot of people making a lot more money. You still got double income, and you've got crypto. You are seeing many, many more crypto millionaires out there that are just sort of overnight millionaires, and that's also at least a small part of it.
I don't know the answer to this. I'm just throwing this out there. I don't really want to go down a rabbit trail on it, but I'm just curious if you happen to have a take or a comment about how the higher interest rates will affect the crypto market.
I will not answer that because I have no idea.
Okay. I didn't know if you followed that or not. I don't follow it per se, so I'm definitely not someone that is an expert on it, but I would be interested to see what happens. But we're here to talk about real estate, right, Richard? So note investing is you and myself, that's our specialty. And so these rising interest rates will make things, I see it making seller financing even more of an option for people to want to sell their house to a borrower on to make a pretty good passive income.
Yes, I think so. And also, one of the things it's going to do is really affect the non-performing market. As you know, right now, coming out of 2008 and 2009, market rates were high, values were down. So it was not easy for people to refinance and or sell their property to get out of their loan that they were going to be foreclosed upon. What we have in the market right now is still relatively low rates. We've got sky high values. So we are seeing people are able to refi. Matter of fact, I've got two of my clients are refining out of their notes right now. They couldn't meet credit standards before. Now they can, et cetera, et cetera. But as rates go higher, it's going to make it more difficult for those people to refinance, and therefore it will increase the number of defaults that we're going to have.
Okay, I can see that happening. So we both think that home values are going to kind of cool off a little bit, and we both see some challenges with the affordability of some borrowers. And so this is kind of, I wouldn't say the perfect storm, but I say this is a great opportunity to really get into the note business.
I would agree. I would agree. If you don't mind being on the non-performing side,
Yeah.
it's the non-performing side, as you know, is not totally passive. Unless you,
Putting it lightly, right?
yeah, unless people want to do something like work with people like us, where we would go in, we'd give them preferred return, and we'd take a management fee, and then have, splits on the upside or something like that. It's a little bit more aggressive. That can be very passive for them. It's higher return, but it's a little bit higher risk too. I mean, let's face it. You and I both know that you don't make money on every non-performing loan that you invest in.
That's true. You don't.
Yeah, I mean, I think you and I have both sustained losses, minimal, but nevertheless, you don't like to even lose $1,000.
Yeah, and I definitely, my experience in not coming out very well on the other end on a non-performer is definitely lack of experience and definitely lack of due diligence that should have been done. So I learned the hard way, and I'm glad I learned on something that wasn't super painful, but it was painful altogether.
Yeah, and so I mean, for those that want to focus on that end of the market, if you're really best to invest in a place where you can get really good comps.
Yep.
So let's take a little Midwest city where you've got a extremely varied market in terms of the housing, all the different types of houses. It's difficult to get a value on something. Yeah. But if you're here in California, or maybe you're in some suburban Indianapolis, where you've got 20 homes or the same builder, you can say, well, gee, those are all worth X. And so you can get within 10%. So it's easier. Now, why is that important? Because you always have to know what your exit is. Yep. And one of the huge values or one of the huge criteria of investing in a non-performing note is to know what your exit value is going to be. Because that way you back into how much you can renovate or need to renovate, or if at all, and that's your driver.
Yeah. So you how the feds get their rate is just pulling a number out of thin air? Well, how the feds come up with what that rate should be?
So, I mean, it's all relative, right?
Yeah.
It's been near zero. The changing of the Fed rate has its limitations, and it's been even more limited. But basically, it is the money supply and controls the money supply. And so it's relative to what it has been. If they go from 0 to 2, that is a huge jump. But if they went to maybe 5 to 7, people may not, and they would never jump at that much. I shouldn't say that that's an increment, but it's all relative. So it's difficult to answer your question very simply.
You got to answer, Richard. It has to be a yes or no. I'm just kidding.
Yeah. And in many things with notes and real estate investing, the answer is it depends.
It depends. It depends. Right. So something that you taught me that I want to repeat is BIPs, basis points. The BIPs is the shortened term for basis points. And what took me a while to figure out, Richard, was 100 basis points equals 1% increase or decrease, however you're looking at plus or minus basis points. So I know that the Fed has been raising the rates, and so right now we talked about the national average of the 30-year mortgage is 5.06%, according to Bankrate.com, which is about 18 basis points up from a week ago. Does that feel like a big increase, 18 basis points in your experience? Or does that feel like a normal market shift?
I think it's in keeping with what they have been doing over the last couple of years. I mean, they've been making a lot of their changes at quarter point increments and being very cautious about it because they don't want to tank the economy, right?
Right.
They could make it a full point and everything's going to take a nosedive, and that's the last thing they want. So they're being very cautious. It's a little bit like turning up the heat on the beef stew that you're making on the stove. You want it to be just right. Get a little bit too much, you're going to singe the bottom. So I think it's very much in keeping with what they have been doing.
So you've been in this business for a while. Do you recall a very large jump from one day to the next in basis points, just out of curiosity? The number come out in your mind that is a large number that increased from day to day.
Yeah, there was some times in the 80s and 90s where there were huge jumps. There was, they were hitting the rates 50 basis points at a time, and that was
daily, right?
Pretty 50 basis point at a time, and they do it like over a 2-month period, 3-month period, and you're going, holy smokes, we just moved 2 whole percentage points.
Yeah, it's a lot. Mm-hmm. So it's kind of like that gambling that is it the roulette wheel that I'm thinking of, where you're just throwing a dart on when it's going to land on black or if the rate's going to go up or not. So hopefully a lot of people, if they were wanting to refi or get out of a higher rate mortgage, they could have done that the last couple of years, and hopefully they're just sitting still for a while until they sell their house, and then they got to go get a loan and get a higher interest rate. But that's just part of the life cycle of having property with mortgages. Right.
And, the Fed, you asked me earlier, what do they base it on? I mean, they get all sorts of advanced Bureau of Labor Statistics data and things like that, far in advance of the rest of the market. So they have a lot of different indicators that they're basing these rate increases on.
So with higher interest rates from the Fed, does that equal higher inflation?
Well, that should equal lower inflation. Okay. Because it means that they're scared about it, but they want to make the economy cool off. So yes, that should mitigate inflation.
Okay. So higher interest rates means lower inflation. Lower interest rates means higher inflation. So we've been in a market of low interest rates for how long would you say, Richard?
What, last 10 years?
10 years. Yeah. Okay. I was going to throw out a number like that, but I wasn't too confident. So I wanted to hear from you first.
Right. They've been keeping rates, and they've been able to do that. And that's one of the things that's been driving the economy. And it's because there has not been any upward pressure for them to do that. So why not? Why? It just facilitates commerce.
Have you ever seen a market like this that's ran that long with those rates, with rates that in the we'll call the low area?
Yeah, I have not. I mean, all through the 60s and 70s, rates were very stable. But back in like 1975, you could get a 4.5% or 5% interest rate on your mortgage, and that was pretty standard. You get it at 1970, you get it at 1974, you get it at 1977. Oh well, this is where rates were. So there was a very narrow band there, but
Okay. So what's my next question here? I had a good one for you, but I like to throw curveballs to you every now and then, but I feel like I haven't thrown a good curveball to you yet. So
okay.
I know we're talking a lot about interest rates today. We typically don't, you and I typically don't talk a lot about interest rates, but just, like I said at the beginning, it just was so fascinating that I just wasn't paying attention. All of a sudden it says 5%, and I'm like, okay, wow, that's, right. I looked up and it was 5%. It's just,
right. One thing I think that we should all make note of is nobody, and I'm not an expert on this, nor is anybody else. They may tell you, there's a whole bunch of highly paid economists out there that'll tell you they are, but they're bad if you look at their batting averages. But nobody expects this to be long-term inflation. Okay. Once the supply chain gets back into gear, prices are going to start dropping. Look at a lot of the indicators. I read an article this morning about, if you really look at the amount of cargo that's shipped via trucks in America is huge percentage wise. It's like 70% of the cargo. And you go, holy smokes. Well, the gas prices are, and a la what's going on in Ukraine and all that, are hugely affecting that. But over the next 4, 5, 6 years, Daimler-Benz and Volvo and all these groups are all experimenting and already actually putting on the road hydrogen semi-trucks and electrical semi-trucks. So that means the gas component is going to start to decrease. So shipping costs should decrease over time. So there's a lot of different factors like that that are going to affect that. And that'll bring inflation and costs back down.
That makes sense. I'm on the same page with you on that. I didn't realize they were making hydrogen semis.
Yeah, there's a big controversy. I was reading about it this morning about apparently Daimler-Benz and Volvo are both betting on hydrogen. And the other large manufacturers are betting on electric. And they both got their pros and cons.
Yeah.
But I don't think anybody knows which way it's going to go yet, but the net effect will be to lower the costs.
Yeah. The hydrogen way is the most abundant resource that we have, right? And
right.
Also the most explosive.
It's explosive, right? And Toyota bet big on hydrogen. I don't think that's paid off yet for them, but just like a lot of people said, well, electric will never make it because how are you going to charge your car? Yeah. Well, guess what? Tesla and other groups are, starting installing electric charge stations, and they're going into restaurants and things like that. So the market starts to change, and you're going to see more of that for hydrogen and or electric either way.
Interesting. So, Richard, getting back to our interest rate topic. So I know you're not the Fed, and you're not going to predict what rates do, but is it going to seem normal if the rates are anywhere between 5 to 7% for the next 5 to 10 years?
Well, one thing I haven't shared with you is that the Fed does ask me before they make
the chairman asks you?
Yeah. I have this little phone over here on the side of my desk. And I'm talking to Powell and saying, hey, dude, what are you doing?
All right.
Yeah. Google also refers to me too. Anytime you ask anything with Google. Google. How do you change a light bulb? Well, it comes straight to my desk. I answer the question. Google,
and then you're typing it out, and I can see you with the 3 dots on there. Then you're misspelling it. You have to backspace and redo it.
That's right. That's right.
I don't do Google anymore. I do Firefoxed.
That's right.
Or DuckDuckGo.
That's right. You're trying to protect your privacy. That's a good thing.
DuckDuckGo.
That's right. So I'm sorry, what was your question before I
So I was going to say, do you think normalcy for the next 5 to 10 years for interest rates is going to be 5 to 7%?
No, I think it's going to drop back down. I just don't see global pressures as being that high.
I don't either. I was just throwing out a number. I thought 4 to 5% seems normal.
Yeah, I mean, you can argue it a gazillion different ways. That's the thing about talking about rates and economies, and there's all sorts of different offsets, and nobody really knows. But I just think that there's a general mitigating effect to the world economy, unless things go totally haywire with Russia and Ukraine, and they keep trying to expand into the Baltics, and then NATO gets involved, and we end up in some sort of huge world war again. I don't see it.
Okay. All right, Richard, we're going to transition to a different segment here. So I just want to let the audience know that this episode is brought to you by BrightPath Notes. Richard, we're going to change it up a little bit. We're not really going to talk about real estate too much. We're kind of going to get into some added benefits that I think that we could provide to a listener on the show today. And so one of the things that I know that you research very well, and you read a lot of stuff. So what is a common source that you go to? And maybe it's a podcast, or maybe it's, something that you see on YouTube or whatever, just to get kind of some information on either the mortgage industry itself, or just kind of a background on real estate and kind of what's going on.
Well, I think a lot of this stuff that you also look at, the Black Knight data, is very good about what's going on. If you're on the more mortgage side, there are just do a general Google, and you'll come up with. Trying to remember what the other one is. That's
besides Black Knight financial data.
Yeah.
Okay. Do you have any podcasts that you listen to help?
Inside Mortgage Finance has a lot of good information. In general, podcast. No, I don't listen to a lot of real estate podcasts.
Just Be the Bank, right?
Yeah, Just Be the Bank. That's right. So I'm not a whole lot of help there, but there's a lot of good stuff out there. Just Google it, guys.
Yeah. What about any books? Is there any books that you really liked to read when you were getting into real estate or throughout your career that you just thought, man, that's a great book to have, either a mindset on running a business or just a book about real estate?
Yeah. The book Built to Last is very good.
Who's that by?
Yeah, that was a good one. I would read a lot of the Business Made Simple stuff.
Okay.
I think that's very good. And that tends to be a little bit more marketing oriented, but
yeah,
he's talking very much about the simplicity and what to focus on and how to message to build a business. And I think that's very good.
Yeah.
That's Donald Miller is the author for all that stuff.
Have you read any of the E-Myth books?
Any of which? I'm sorry?
The E-Myth.
No, I haven't. Tell me about those. Yeah.
I'll have to explain those to you offline. Those are interesting books. I know someone else that I had on I think it was Zarina Harris. I had her on the last episode. She mentioned about the E-Myth, one of the E-Myth books that I think Michael Gerber, I want to say his name is. Maybe I'm butchering that up. It's been a minute since I read it. You think I would know because Zarina was just on not too long ago. But
yeah, if you're like me, a lot of these titles just sort of fly out of your mind.
Yeah, I hear them all, and they get them all confused. The author confused with a different book.
Right.
So, all right, Richard. So, what is Richard's thought on? Let me see. I told you I would throw you a curveball.
Mm-hmm.
And I haven't thought of a good curveball yet during this podcast here. And I know this isn't scripted, by the way, for the listener. This is all kind of, I have an idea in mind of what I want to say and what I want to talk about, but I like it to be more authentic. So it's not super scripted. So, are you gonna leave California?
No, I know a lot of people are because costs are so expensive out here, but no, it's sort of like living in Manhattan. Manhattan is so expensive.
Yeah.
But sort of once you're in that game, if you get out of it, you're out of it. You're not going to get back in. But it's okay if you stay there. So no, I'm gonna stay. In terms of other books, let's go back to. So I mentioned Donald Miller. Never Split the Difference by Chris Voss.
Yep. Okay.
That's very, very good.
That is something I think anybody should read if they're in sales or if they're in business, growing a business. That's definitely a book that you just need to read. There's so many great applications in there that you just don't think about psychologically.
Right.
I think it definitely gives you an edge.
So Simon Sinek has got his Start With Why.
Mm-hmm.
That's a very good book. And then a fellow named Robert Cialdini, I'm probably butchering his name, but he's got a very good book called Influence.
Say that 5 times fast.
Yeah, exactly. But those are all very good. Michael Malkowitz has got a book called Profit First.
Yeah. Okay.
I've read all of those, and those are all good reads.
Are you a hardback book guy or are you an electronic reader?
I'm an electronic dude. I have a hard time just sitting in one place. So I've got to carry it around with me and listen to it and or read it on an ebook or something like that. But
I'm an e-reader as well. I have read paperback books, but I definitely prefer the e-reader. It's just so much easier just to have it, and then it saves my page for me. I always lose the page I was on, or I'll fall asleep while I'm reading, and then I'll have to figure out where I was. So
yeah, it's kind of bizarre, when the digital first started coming out, especially for like the newspaper. I used to get the New York Times religiously, and I thought, why would anybody want to go, digital, because you've got it. And then they offered you a digital teaser, and I started to read it on my iPad a little bit more, and slowly, and this is obviously what they wanted to happen, I slowly actually started to prefer digital. And now I can't even. I saw somebody with a newspaper in public transportation the other day, and I thought, that's nuts. In New York, in New York, they used to practice the New York Fold. Do you know what that is?
No.
So if you ride the subway or a taxi, there's a certain way you open your page, and then you fold each page in half, and then you fold top to bottom down. So the newspaper is only about a quarter page in size. And so if you do that, it's the least obtrusive way for you to read that. Then you have to unfold it and refold it and keep doing it. But we no longer have to practice the New York Fold.
The information that comes out of your mouth, Richard, it doesn't surprise me anymore.
My significant other says it's a whole lot of meaningless trivia. She's right.
Hey, I'm glad you retain it, because it was entertaining for today. So thank you.
Yeah.
And thanks for being on today's episode number 8, brought to you by BrightPath Notes. So I'm Justin Bogard. My guest here is Richard Thornton. And for all of you listening out there, I will catch you on episode number 9. So take care, everyone.
Bye.
Thanks for listening to Be the Bank. We hope you learned something from today's show. If you enjoyed this episode, please rate and review us. Plus, check out our BrightPath Notes channel on YouTube and follow us on Facebook and Twitter at Be the Bank and on Instagram at Be the Bank Podcast. Be the Bank is sponsored by BrightPath Notes. Thanks again for listening.